wasn't that. Our benchmark was Bitcoin, right? So we were actually just trying to keep up with Bitcoin. So I think you could have guessed that Bitcoin would actually outperform the S&P. And our initial goal was, how do we get to the point where our company's market cap tracks Bitcoin's market cap? But, along the way, we levered the company. And the only way to beat Bitcoin is more Bitcoin, right? And so that's why every time people offer you, they pitch you all these business ideas, right? And they're like, well, do you want to invest in this business or that business, or do you want to invest in this real estate? And I say, well, Bitcoin's up 46% ARR every year for the past 4 years. So, and that varies, but anywhere from 45 to 55% is the ARR for Bitcoin. So I think, okay, so 50% is my risk-free return. So are you going to give me a proposition which is risk-free better than 50%? And of course, no one's got a proposition that's risk-free better than 50%. So then the question is, well, how the heck are you going to beat better than Bitcoin? And the answer is, the only good idea is borrow a bunch of money for 5% and buy Bitcoin with it. Right? If you can borrow money for 0% or 1 or 5 or 10% and you're buying Bitcoin and it's returning 40 or 50%, then that's a good idea. So I think Bitcoin's a good idea. I think different ways to securitize or lever Bitcoin, some are bad ideas, like, for example, trading 20x leverage on Binance on Saturday night. That's not a good idea. Trading on FTX, on the crypto exchanges with mark-to-market massive leverage is not a good idea. But, if you can take a 30-year mortgage at 3% interest and buy Bitcoin with it, that's a good idea. And maybe you remember, you lived through the many epics. The last epic is about a 45 to 50% ARR. The previous ones were higher. And I think it's the law of large numbers says that as Bitcoin approaches the market cap of the S&P index or the market cap of all the equities in the world, it'll start to approach an ARR and a volatility which is lower. I don't think it'll ever get to the performance of S&P. I think it'll always be better than the S&P index. And I think right now the ratio is 46% for Bitcoin versus 12 or 13% for the S&P. So it's 3.5x performance, and it's 2.5 vol. So the Sharpe ratio is higher, right? There's a higher Sharpe ratio of the S&P. The performance is much higher. And I just believe over time, Bitcoin will converge toward the S&P times 2 and 50% more volatility in the S&P and 2 times performance. Or if the S&P, gives you 12% a year, then Bitcoin ought to be 20% a year. And so that being the case, we did this Bitcoin 24 model, and the 24 model is a 21-year model. And my base case is 29% ARR for the next 21 years. And at 29% ARR, you end up hitting $13 million of Bitcoin in 21 years. So that being the case, coming back to every pitch I get, okay, well, you have a pitch. Can you guarantee me 29% ARR risk-free? And another way to say it is, that's the risk-free rate. So can you give me 39% with no additional capital required for the next 21 years? And if so, it's still not a good idea because it's a distraction, right? Right? It's still a distraction. I'm taking risk, but it's maybe an interesting idea. But of course, as soon as you set that as the cost of capital, 29% risk-free, I mean, the risk-free fiat rate right now is 5%, right? Or actually, after tax, really the risk-free rate has got to be the after-tax bond yield, so maybe it's 3%. So it's 3% if you think conventionally in fiat terms, but if you're thinking Bitcoin terms, it's 29%. For me, you can have a different forecast. But it's very clarifying, right? Because as soon as you actually set that, you think, well, there's really nothing that interesting to me other than What's interesting is companies that can raise capital to buy Bitcoin and intelligent leverage ideas, like raise $1 billion for 0% interest and buy Bitcoin with it for 7 years. Like, those ideas are interesting to me, but there has to be Bitcoin on one side of the idea, and the other side of the idea needs to be an arbitrage of the extremely cheap fiat interest rates.
Yeah, so I think I saw that presentation. It was very interesting, and I wanted to discuss it with you. So I got the slides here uploaded. Let's share them. Oh yeah, there it is.
This is from Nashville.
Yep,
Yeah.
the one from Nashville. Okay. So this is the forecast that you made.
Yeah.
So here you're saying the bear case is Bitcoin's at it's making about 21% annual return rate. Base case is 29% and bull case is 37%. But in context, this is I think it's worth mentioning here that this is compared to a world in which, so these other assets are also making rates of return. So Bitcoin is at 29%, but gold is at 5%, art is at 9%, equity is at 10%, and real estate is at 7%, bonds are at 5%, and money is at 7%. So I found this really interesting, and I sat and I ran a bunch of numbers, and I thought about it a lot. I think it's a very interesting way of thinking of Bitcoin, because you're projecting different appreciation rates where Bitcoin continues, and now this gives you a sense of what the scenarios are going to be depending on what happens to the Bitcoin price and all these other things. But I think the way that I thought might be more useful to think of this is to compare Bitcoin only to bonds and money rather than these other things, because these things you would expect that in the long term, as you say, as Bitcoin becomes more useful as a medium of exchange and as a store of value, people are going to get rid of their of the gold, art, equity, and real estate that they hold as a method of saving, right?
First of all, this Bitcoin 24 model we put in the we open sourced it. It's in the public domain. So if you just Google Bitcoin 24, you'll find the GitHub. When you go to the GitHub, you can download that spreadsheet. That spreadsheet has a macro model, a Bitcoin model, and a bunch of micro models for corporations, individuals, institutions, and nation states. In the model, everything's annotated. All of the assumptions are there, and you can change the assumptions. And in this particular case, there are assumptions about the inflation rate, macro inflation rate over the 21 years. There are assumptions about the innovation rate. And then there are assumptions about the monetization or the demonetization of various asset classes. And if you look at that slide, what you can see is we're assuming a progressive demonetization of gold.
Yep.
And a demonetization of bonds and to a certain degree money. But, we're assuming that there's going to be innovation, and equities will benefit from things like technology and AI. Like, for example, if all the cars in the world drive themselves, or you can manufacture humanoid robots, then maybe you'll see companies that have no employees, but they sell millions of humanoid robots made by robots, so the equity will be valuable. So there's some asset classes that look like they'll grow, that we think will grow faster than others. And art, like there's, you can look at that variety of different ways. Maybe you think art will be demonetized faster, in which case you go tweak that, and in this particular case, this is showing it creeping at 9%, but you could view art as gold and decide it's only going to creep at 5%. We just figured art would be better marketed, and it's prettier than gold over time. We're thinking, but anybody can go and adjust these things and make their own assumptions about what'll happen, and then they can come up with their own macro view of the world. That's what's cool about the model, and I would definitely encourage you, Safe, to grab the model, look at the assumptions, tweak it, and come up with your own Bitcoin view and your own macro view. Because I think when you start to ask the question, how does equity sit with real estate, sit with bonds, sit with currencies and art and gold as a long-term store of value? That's very interesting. I mean, I think you've encouraged all of us to think that way. And I just see the world as there's a bunch of assets that have utility value. And then there's assets that are primarily store of value, and And if you think about the portion of our long-term capital, our store of value, clearly that ought to be moving toward Bitcoin much faster. And then everyone's going to want to have their place to live and things that they like, that they brag about, their trophy assets. My self-image is I own the football team, right? And so some people will pay a lot of money because the idea of being the owner of the New England Patriots is worth billions of dollars to them if they're a citizen of Boston or something. So there'll be things like that. But ultimately, clearly, Bitcoin is global capital, and it's the best asset. So we think it'll grow the fastest. And that model, my base case there is 0.1% of the wealth in the world growing to 7% of the wealth in the world. But go ahead from there, with the caveat that you're working with my base case and you can have your own. It's everybody can have their own assumptions. What are your thoughts?
Yeah, so I actually did exactly what you said, which is take these numbers and look at them and to try and run them myself. And I think, so it's tricky. I think the tricky part about thinking about these numbers is to think about how the change in the value of the money supply is it reflects on the change in the growth rate for the money. So you put a 77% annual rate of return on money,
Yeah.
which suggests that the value of money increases at 7%. But in reality,
Well, value is a funny word.
exactly, that's the tricky part.
We're just cranking in the monetary inflation rate for the past 100 years, which is your number, right? So,
Yeah.
so in US dollar terms, right? So an average increase in the US dollar money supply of about 7% is the base case.
Yeah, but
The value of the money isn't going up. The value of the money is flat, right? I mean, right? We've already established that, right?
well, but that's the tricky part because it's not exactly staying flat. It could go up or it could go down. So the supply, it's in a sense, it's a little bit like you're comparing apples and oranges when you're looking at Bitcoin up 29%, which means up 29% in terms of dollars. Okay, but then what is the
That's
dollar
true.
up in terms of? So I thought the way that I would formulate this in order to
Oh yeah, you can actually calculate real as opposed to nominal. And the problem with real is, again, the price of every single thing in the economy is changing at a different rate.
yeah.
But so yeah, this is obviously it's just a nominal number over time, and we're just cranking in a 7% increase in the currency / fiat money supply as the base case. If it was, Turkish lira or Argentine peso or something, and you cranked in 14% or 21%, you're going to have massively larger numbers. But of course, there's no point in that because the world reserve currency is the dollar. So yeah, we're coming back to the US dollar base rate. And we didn't build it to forecast currencies versus currencies, right? They're all just thrown into that bucket called money.
Yeah, I thought one way to get around this is to think of the Bitcoin annual rate of return as being opposed to a bear case, a basic case where bonds and money is set at zero. So that way, we're just thinking about the growth in the market cap of Bitcoin in terms of bonds and money, because that's really, in my opinion, what Bitcoin's up against. Whereas the others, I think, would.
Well, we disagree with that. Like, I don't agree with that at all, right? In fact, I think that Bitcoin is not up against that. I think that Bitcoin is competing with all assets. It's clearly demonetizing gold. It's also an alternative to real estate. It's also an alternative to equity.
Gold is a rounding error next to money and bonds. You're talking about 400.
Gold is not a rounding error compared to Bitcoin. It's 10x bigger than Bitcoin.
Yeah, but I like to say gold is the appetizer, fiat and bonds are the main course, and real estate and art.
You have an opinion. I just disagree with your opinion. I just think you're characterizing this very narrowly. There are a lot of people that are going to buy a Bitcoin instead of buying a second apartment as a rental investment property. Yeah. Right, and you want to dismiss that as relevant, but it isn't irrelevant, right?
No, it is relevant. I think
the fact is everybody has to they have to decide how they're going to allocate their wealth across all these assets. And there are some people that make a lot of money and they buy one house, a second, a third. I know people that buy 27 houses. Okay, I know them. Like the term land banking has been around for 30 years, as long as I can remember. People just take money that they made in their random investment banker job and they buy real estate just to bank the money, right? So I mean, this is not, Bitcoin is not just a competition against currency. And you can argue, for example, in the United States, it's absolutely not a competition against currency. In the United States, people aren't buying Bitcoin in lieu of holding dollars. There's no one with capital to invest that hasn't invested in dollars. I mean, every investor in the world has their capital invested in the stock market, primarily in equity or real estate, right? Otherwise, some people might be invested short term for bonds, but wealthy people in Europe and the United States aren't choosing between moving from US dollars to Bitcoin, right? They're choosing to not buy a building or not buy land or to sell their NVIDIA stock to buy Bitcoin. So those comparisons really are pretty important to people in the Western world.
Yeah, and if you see here, I think you can see my screen, right? So if you see here scenario 2, this is the one that I was referring to, where I said bonds and money gave them an ARR of 0, so that they're the metric that we're measuring against. So how much is Bitcoin going to grow on top of the real growth or shrinkage in the money and bond markets? And then we give gold, art, equity, and real estate negative ARRs, which is, in my opinion, not for the assets themselves. The equity market isn't going to go to 0, but I think people using equity or art or gold for the sake of saving is what's going to trend towards 0, in the sense that, all of these people you talk about who do land banking are going to, over time, realize that Bitcoin is better, and you'd expect Bitcoin to decrease, and then land markets are going to be for buying land. If you need the land, you buy the land. If you need a way to store wealth to give to your kids, you just buy Bitcoin. So if you run these numbers, I found that it is actually at exactly 29%, the same number you gave as the base case. If we give Bitcoin at 29% and give bonds and money 0, in your case you gave bonds a slightly less, 5%, I think it was less than Bitcoin, and you gave money a 7%. But if we give them 0 and we give Bitcoin 29, and then we give gold -1, art -1, equity -1, and real estate -4, because that's a lot bigger, it has a lot higher to fall. So if you do this, by the end of the 21 years, we'll see this is the point. At 29.2% is the point at which Bitcoin becomes bigger than bonds and fiat money. And at that point, it's also, the other things, gold, art, equity, real estate, they lose their monetary premium, or at least most of their monetary premium. They're held for their utility or for their return, not as a form of saving. So at this point, Bitcoin would be about 260 compared to fiat and bonds of 140 and 120, which is where they are right now. So this is not, I wouldn't say this 260, I wouldn't measure it in terms of trillions or billions. I think it's more useful to just think about it in terms of the change from now until then. What do you think of that?
I'm not quite sure I'm following. What's the point of this? Because in 21 years, I'm not quite, I don't even think your units aren't nominal, your units are real. So I guess you're calculating something.
I'm just looking at them related to one another.
I don't get it. So I don't have a reaction because I don't understand what you're trying to say.
What I'm trying to say is that we're not measuring them in terms of dollars today or tomorrow. We're measuring them just in terms of ratios to one another. So at this point, bonds and money, if you add them together, are worth as much as Bitcoin. So imagine a world in which if we have 29% outperformance of Bitcoin outperforming bonds and money by 29%, which so far has been doing more than that, because so far bonds are down over the last 2, 3, 4 years, 5 years, and Bitcoin's massively up. So it's been at least double 29%. But if it keeps carrying this on for another 21 years, then at 2045, Bitcoin's bigger than bonds and money at 29% of growth.
Well, again, I would encourage you to to actually take the Bitcoin 24 model, find a way to crank your assumptions in and spit out the nominal map or the heat map of the asset distribution in the year 2045 and show that versus the one that we've created. Because you want to go back to the one that we have in our base case? Or that
Yeah, but I mean, yeah, here it is.
You can debate it one way or the other, but here, in this base case, we're assuming that even if Bitcoin grows at 29% ARR, and that's a nominal ARR, right? Then bonds are actually going to be a larger asset class than Bitcoin in the year 2045. And, and equity will be a larger asset class and real estate will be a larger asset class. So we're only forecasting in this base case that Bitcoin will be much larger than gold. We're not forecasting it would be larger than the class of all equities or the class of all bonds.
I did it.
So
I made Michael Saylor sound bearish on Bitcoin next to me.
So I don't really know. If you want to generate your own forecast, it has to be in nominal terms in the year 2045. Then we can compare it to this one and talk about the difference. But I mean, the whole point of that model is everybody can crank in their own assumptions and spit out a result in nominal terms over the next 21 years. And it gives you charts and it gives you the heat maps. And you can decide. I mean, it seems to me, I think that the S&P index and that equity indexes will continue to appreciate. And I think if you look back, the money supply versus the S&P has been pretty correlated. So if the M2 money supply expands at 7%, I would expect that equity will track that. And here, this is a bit bullish. There's an assumption here that equity will outperform the money supply, but you can come up with a bearish assumption where equity underperforms the money supply. I mean, clearly this chart is we're a bit bearish on bonds. Bonds aren't growing as fast as an asset class. Real estate is tracking. Equity we're kind of bullish on. Art we're a little bit bullish on. Maybe we shouldn't be. And then gold we're very bearish on, and Bitcoin we're triple bullish on. So that's what this assumption is. I don't think that bonds are going away, Safe. I think as long as we have nation states and we have cities and states, they're going to borrow money and they're going to keep expanding the sovereign debt, and I think there'll be corporate bonds as well. So I don't think they go away, and I don't think equities go away unless we lurch into a socialist, more communist type state. I think the argument in favor of equity values going away is you have to basically argue that the state will move to expropriate, regulate, and tax out of existence the equity values, and they could. So this is kind of bullish on capitalism, right? This forecast, like companies invent stuff and they're able to keep their earnings, right? So it's a fairly bullish on creativity. Very optimistic about technology innovation, optimistic about capitalism, optimistic about transformation, pessimistic about the opportunities for gold. Art's a small thing. I don't really know one way or the other, but at the end of the day, it doesn't really matter that much given the fact that my advice, if you're a Bitcoin maximalist or a Bitcoiner, is you shouldn't be investing in anything other than Bitcoin. Right? I mean, Bitcoin is, you've got an answer. There's one winner. Everybody else is a loser. Right? And so the question is, are they going to lose big or lose small? And if you came to me and said, I'm going to find a strategy to short the bond market, I would say, I don't suggest that either. You might lose your shirt. So I don't know how to short, or I don't know it's very wise to be shorting most of these things.
Well, I mean, buying Bitcoin effectively is shorting them in a way.
Yeah. The takeaway from this is that Bitcoin can win and the world doesn't necessarily have to turn upside down. Right? But when Bitcoin is the global monetary asset or the global monetary index, it still may not be as big as equity capital. It's just going to become much, much more material than gold and much more useful than gold. And, the dynamic between all the rest, it's a function of, are states running deficits or not, and how do they handle their issues? And this is an optimistic forecast. If you come up with a pessimistic forecast is the only thing that's left is Bitcoin, right? Like, for example, if I have a pessimistic view of a nation state, the stock market collapses and the equity goes to zero, and the currency collapses and the money supply is not worth anything, right? And maybe the real estate isn't worth that much because the rents aren't worth that much. But the challenge is, it's easy to forecast that for Venezuela or Cuba or North Korea or Nigeria, right? You can forecast it for a small developing country that's either poorly run, mismanaged, or communist, or dysfunctional with hyperinflation or a war zone. It's hard to forecast that for the entire world, right? If the entire world, imagine a forecast where all the currency of the world goes to zero and all the companies go to zero. Well, that's a big problem. So I'm not thinking that. And this is just a global macro model. It's not a micro model. So in the global macro model, the assumption is the world government works, all these governments work through a bunch of issues, and they eventually figure out how to not make things much worse. And then technology advances, and we get humanoid robots, and we get AIs that actually do useful thinking. And then we figure out how to, unleash, the power of 100 million AIs to make the world a better place. And there'll probably be companies that make a fortune, the next Facebook, the next Google, the next whatever, and their equity market caps will be quite high. And meanwhile, capital will be created by human productivity, and a lot of that capital will flow into Bitcoin because Bitcoin's digital capital. Some of that capital will flow into real estate and equity. Companies are going to overcapitalize. Like if Apple makes $500 billion in selling the iPhone, and then they pour the $500 billion back into buying their own stock, right there, they're kind of supporting Apple as a long-term store of value capital asset by pouring their $500 billion into Apple stock. So I think we'll see that. Now, the conventional view of capital is I pour all of my cash flows into buying my own stock back. And that's what Meta's doing right now, and that's what Apple's doing right now, and other companies do some of that. The unconventional view is I take my cash flows and I buy Bitcoin, right? And so if the world goes completely rational, digital, then we will demonetize equities faster, right? And if the world stays very conventional, we will continue to monetize equities and real estate to a greater degree, right? And sovereign debt and bonds, right? I think sovereign debt, real estate, and equity are conventional capital assets for corporations and big institutions and the like. And Bitcoin is the 21st century novel capital asset.
Principles of Economics, my complete guide to understanding economics, is now available in hardcover, audiobook, and ebook from Saifedean.com, Amazon, and many more booksellers worldwide. And now I am also teaching a course based on this book on my website, Saifedean.com. Principles of Economics will run the whole academic year, from September to June, and will have a new lecture every 2 weeks, as well as weekly live online discussion seminars open to learners from all over the world and from all walks of life. Whether you're a student, a professional, or a retiree, you are making economic decisions every day, and this course will arm you with the wisdom of centuries of economists to improve your economic decision making. You'll also get a free book of Principles of Economics if you sign up for the course. Go to Saifedean.com and sign up now.
And the interesting question, right, is at what rate does Google decide that they're going to start to buy Bitcoin with cash flow instead of buying treasury bills with cash flow? Or if I generate $1 billion a month and I'm a big tech company, I can buy treasury bills, probably U.S. treasuries short dated, or I can buy my stock back, or I can buy Bitcoin. And as a practical matter, I don't really think there's that much else you could do. Oh, you could dividend out your cash flow, right? And so, I mean, those are really your choices for the most part, and that's what the big tech companies do. So the interesting question is, at what rate do I go from buying my stock back, where I'm basically capitalizing my equity, or do I buy the treasury bill, which is capitalizing sovereign debt, or do I go to buy Bitcoin, which is digital capital, capitalizing in Bitcoin? And that's a regulatory issue, and that to a certain degree, and that's also an issue of corporate finance doctrine. Like, when will business schools start to teach CFOs that they should take all of their cash flows and buy Bitcoin with them, or half their cash flows and buy Bitcoin with them? And if that changes, then Bitcoin monetizes much faster. And if we're traditionalists, right? Like right now, the big bulge bracket banks, they can't custody Bitcoin, buy Bitcoin, or sell Bitcoin. So that's a huge impediment to Microsoft, Google, Apple, Amazon adopting Bitcoin as their capital asset, right? You're not going to see mega conservative corps do that until they can wire $1 billion a month to Citi or Bank of America or JP Morgan and just have it converted and held in a capital account. So when that happens, when SAB 121 gets repealed, or when there's support for banking Bitcoin in the traditional banking system, I think that accelerates the monetization of Bitcoin, and it accelerates the demonetization of equity and debt. But you can fixate on saying, oh, well, this is all just about using Bitcoin instead of sovereign debt as a capital asset. But I could argue that right now Microsoft, Apple, Google, and Meta have already decided they're not using sovereign debt as a capital asset. Right? They decided 20, 30 years ago that debt is a bad capital asset, so they're really monetizing their own equity. But either by buying their equity back, or they're overpaying for other equities. When they do these mergers and acquisitions, if you're a CEO and you've got a lot of cash, you either got to go buy other companies and they overpay. 90% of acquisitions they overpay and they're diluted, right? So we're monetizing private equity, or monetizing all sorts of other equity, or we're monetizing public equity. And if I didn't have to, I think Meta is going to do a $55 billion share buyback. Well, what if I bought $55 billion of Bitcoin instead of $55 billion of my own stock? Right? By the way, and here's an interesting one. The stock becomes a derivative of the Bitcoin if I capitalize on the Bitcoin. So if you're doing this macro model, you could say, well, that means that the 55 billion goes to Bitcoin and it goes away from Meta, but it's not quite, because if Meta buys Bitcoin, then the market cap of Meta probably increases by $200 billion. And so the equity gets larger, and then if you were really sophisticated, you would be saying, what percentage of the equity is backed by the Bitcoin in that model, which we haven't worked through that second order issue. Right? But you could imagine, like, a rational world is Amazon, Microsoft, Meta, Apple, they all buy Bitcoin with their cash flows. I mean, Apple would be worth an extra $1 trillion, right? If Apple basically started buying $20, $30 billion a year of Bitcoin, they spent $500 billion on their stock. Where would Apple be if they bought $500 billion worth of Bitcoin right now? I mean, granted, it was over a 10-year time period, but if you look at that, right, how do you increase the market cap of Apple or Meta by $1 trillion? And the answer is, you start to take your cash flows in your treasury, and then you buy a capital asset that's plus 40% a year instead of one that's minus 4% a year. And when that happens, you can see in our macro model, the equity market's going to look good, right? That's going to put a boost in the S&P and the NASDAQ and the Magnificent Seven. So it's not, I guess my point is, I don't want to be a doomer like Bitcoin good, everything else bad. Because the truth is, you could say Bitcoin good, equity bad, and bonds bad, but if I actually back the bonds with Bitcoin, and if I back the currency with Bitcoin, and if I back the equity with Bitcoin, then they're all going up, right? So it's like just Bitcoin better, and everything else is actually going to grow, and that's the argument for Bitcoin just makes the world a better place, right? It's the constructive, cheerful, progressive, grow out of your own problems with a good technology, vision, as opposed to, this nation is going to melt down its currency and its banks are going to melt down and we're all just going to jump on a lifeboat. So
I don't think that is the case. And in the fiat standard, I discussed this in detail. And I think I don't see it as necessarily having to be something that is disastrous, because I just think, as you described, people are just going to start holding more and more Bitcoin. Now, I mean, you're the one who said it's going up forever. Going up forever means eventually it's going to reach a point at which it's going to be larger than pretty much everything. It's just going to keep going up. Yeah, so this is, if you see here in the yellow, these are your projections. But then I think the comparison is in terms of percentages. In your projection, Bitcoin remains at around 7% of global assets, and money and bonds are 12 and 21% in real terms. So here are three different scenarios that I put up, which I thought would be interesting. Okay. So in the first scenario, Bitcoin goes up 25, and art, gold, real estate go down, and equity go down -1 and -4. Oh, and to add,